Yeah, after part three, it could be expected that it's now part four, which is coming, and indeed, that supposition is true. So, last time we spoke about the objective tax liability in German inheritance tax, which is rather a high-level term for which events can trigger the tax. And last time we spoke about acquisitions on ground of death. Well, and now let's talk about the second alternative, the donations between living persons. So that could also be simply called gifts. It's a matter how you translate it. So you will probably also very often find the term inheritance and gift tax as translation for the German Erbschafts- und Schenkungssteuer, and both are equally good or bad. I think we should not stick to debate, or we should not begin debates about the words. So if you can live better with the translation gift, take it. That's nothing where we should think about too much. Okay, now the decisive question is, what is a donation between living parties? So, yeah, the first alternative, you get something because somebody dies, and now you get something as a gift from somebody who is still alive. That seems evidently to be the basic meaning. But now, what's a gift? What's distinguishing a gift from something else? And that must be defined, because the matter is too fundamental in order to be left open. Here, half of that law relies or is funded or is dependent on how you understand the word gift or donation, so you need to define it. Otherwise, you would have too many open questions. So that comes in paragraph 7. The paragraphs up to paragraph 6 are used to define or regulate special problems combined with acquisitions on ground of death. So paragraph 7 is used for the donation area. The first and basic definition is that a donation or a gift is any generous gift made between living persons as far as the donee, so the person who gets the gift, is enriched by it to the cost of the donor. So the gift must be generous. So something which you just do out of an obligation or so can't be a gift. The idea must also be to do the other person something good, and not to do something good only for yourself. Things which you do just as a gift, as a remuneration for work or so, that are also not generous. So all the things which are regarded as an additional wage payment, even if it's voluntary, would not be classified as a generous gift. It would rather be seen economically as a remuneration for work. Okay. A gift must be able to enrich the recipient either by saving you costs or by increasing your property. So being nice is perhaps a gift of heaven if your boss is nice to you, but it doesn't enrich you. So what you get must have a monetary value or monetary or property consequences. So a nice atmosphere, a nice behavior or so, no, can't qualify for that. And it's necessary that the donation causes costs for the donor, so that the donor really has to renounce on something. You have to give away something. If you just allow that somebody else profits from some occasion, probably it's difficult to say this is at your cost. So it must be something which the one person gives away and the other person gets, and it should have a monetary value. Must have. In most situations, identifying a donation as such does not really pose problems, at least not the things where we talk about. So just keep in mind a donation is a gift, something done out of generosity, and naturally things which don't have a monetary value can't be taxed, so it seems to be evident that this is excluded. Okay, now there might be events which are not really fulfilling that basic definition, but which should also be taxed, so the list is a bit longer. What somebody receives in consequence of the fulfillment of a condition connected with a donation made by the donee or connected with a contract between living persons without having to make a corresponding payment. Sounds rather complicated, and I believe that is also complicated. What you see here, the basic definition for a gift seems plain and simple, but when you put it to the test, there might be cases where you can't catch a certain event, although you have the idea economically it is a kind of equivalent to a donation, or you could use that way in order to avoid the classification of a donation and so to avoid a tax of 20 or 30%. And so you must close that loophole. Now, what could be regarded as an example for the thing which we have here? For example, I might be willing to give you a donation of 2 million euro. But on the other hand, I think your sister should also get some money. And I say, before I give you the donation, you have to hand over your own house, which has a value of 500,000 to your sister. Now, why would that be a nice trick? Because from your side towards your sister, the 500,000 would not be a donation because your motive is not generosity. You are forced to do this by a condition which I imposed on you, an obligation. So that would not be taxable in the relationship between the two of you, and in the relationship between me and your sister, it would not be taxable due to the simple fact that the money which went to your sister or your house didn't come from me. No? You can't say that was a donation which I did or caused to your sister, because it was not something generous which was to my costs. So classifying this as a donation between either me and your sister or you and your sister would fail. On the other hand, naturally, it is a kind of a donation. I just cause you to make a property transfer without consideration. So that's a loophole, a gap in the list, and so naturally that had to be closed. Otherwise, we would always develop such things as a trick. And good. Now you will see in the list which the things which come will be rather strange, rare occasions. And what you can learn from that list is not that all these things are so relevant. What you can learn from the list is when you set up a tax and there is a kind of doing that what shall be taxed here, giving money for free to others. If there is a way to do this, which is not covered by the basic definition, then these transactions or these things would become very relevant, because then they would be a way to avoid the basic definition of the tax event. And then everybody would choose them in order to hand over money. And And you can't leave these doors open, you must close them, and that is why such a list gets wider and wider in the course of time due to historical experience. Every time when somebody found a way how to avoid the tax and nevertheless do what was intended to be taxed, then you have to make the list a bit longer. For example, here, a strange thing, the enrichment which a married partner or life partner gets if the marital status of community of goods is agreed upon as ownership status in the marriage. The spontaneous feeling is probably you are bewildered, puzzled, confused, even irritated. And what you need to know about this is a bit of a civil law. There is often the rumor or the wrong idea that if people are married, they are liable for each other's debts and that they own their property together. This is not only far-fetched, it's simply completely and totally wrong. At least in the German law, if you marry, that has no effect on your property and ownership situation. So what you own is your own, and what your partner owns is his or her own. There's no doubt in that. So this is even normal situation. So your partner, your spouse can go bankrupt and it will not affect you. You are not liable for the debts of your partner. On the other hand, if you end up in complete economic misery, you have no claim that your partner pays for you apart from the financial support which can be claimed so that you don't die or so. But on the other hand, you have no direct claim, no ownership partly in what your partner owns. So complete separation of the ownership situation. The only thing which German law added in the standard status for married couples is that when the marriage ends, then there is a kind of compensation. Then it is compared how much richer each partner got during the time of marriage, and you have then to equalize that. So you compare the increase of property which both have, and that increase is then at the end of the marriage shared. What does that mean? So that means during the marriage you have no claim to your partner's enormous wealth, but at the end of the marriage you can claim half of the increase of wealth which your partner made during the marriage. So to have an example, A and B marry at the age of 20 and both have a property of 10,000 each. Later, A takes up a well-paid job, let's say investment banker or something brutal like this. And B takes only a half-time job or no job at all and takes care of household and children. So very traditional. So during the marriage, A has his money and B has her money, or his, depending on the role situation. So B is poor, can't claim any money. If A is greedy and mean, B lives a very poor life. Now, when it comes to the utmost and B says, okay, that's it, I am going, then there is the assumption that A would never have had such a success if B had not worked together. For example, if there had been another share of the household and job work, the workload in these two roles, then A could have not been so successful, so that the financial success of A is partly due to B. And at that moment when the marriage is dissolved, then it's said, okay, now the wealth increase has to be equalized. That means we look now. A has at the end of the marriage, let's say, a property of 501 million, so 5,010,000, and has a future claim already achieved for future pension payments of 5,000 a month due to his excellent job position. B has only a property of 20,000, and due to the lowly paid jobs which she or he was forced to take or was willing to take with regard to the other partner's position, has only future pensions achieved of 500 per month. So poverty is guaranteed. That is not regarded as just and fair. So at the end of the marriage, the property, the present one and the future one, is shared. So A got richer by 5.0 million during the time of marriage, half of which has to go to B. And the pension claims have also, as far as they have been founded during the marriage, to be shared. So the institution paying the pension will be informed that instead of 5,000 to A, they will be obliged to make pension payments of 2,500 to A and B in the future, so that she, in her old age, or he in old age, at least B in old age, will get 2,500. So if you're married and you contribute to a pension plan, you must see that if you then get divorced, that then only half of your pension claims will remain. At least in the marriage, in the divorce trial before a court, there will always be found an adequate solution. If you don't want this split of pension claims, there will have to be presented an economically equivalent solution. Well, so B has only had an increase of 10,000 in the property and pension claims of 500, so 250 should go to the spouse on dissolution of the marriage. And naturally, you will restrict yourself to just handing over the net amount, the net difference. So this constellation here will end up with A having to pay over 5 million, no, 5 million minus 10,000 for, no, 2.5 million minus 10,000. Sorry, that was a typing mistake. So his half minus her half is the money which he has to hand over to B. And the pension claims will probably be shared in a way that 2,250 have to be ceded to B. By the way, this is a rather nice compromise because during the marriage, even the most conservative, greedy, and mean, let's say, husband can feel happy. My money is my money. My wife has no claim to my property. Yes, perfectly right. But from the moment when you overdo it and she says, darling, I met a nice lawyer yesterday on a theater visit and he presented me his business card. What about a fur coat and a new Mercedes car as a present for me? Then husband probably says, no, why should I pay for your personal luxury? And then probably says, okay, it was a lawyer and he a business part. The guy is specialized in divorce trials. And if he then still is too greedy, then she draws the emergency brake, files for a divorce, and then she gets 2.5 million. So this is a kind of indirect guarantee that the poorer partner in a marriage can always sufficiently economically profit from the wealth of the other partner. So officially everything is separate ownership, but you will never overdo it. And indeed, I know no married couple where the one partner lives in luxury and the other partner is then excluded from that luxurious lifestyle and has to eat bread and butter only. Yeah. On the other hand, if one of the partners falls into insolvency, that doesn't affect the wealth of the other partner, which can often be kind of a life-saving instrument for sole traders when they go bankrupt, because then not all the property of the family is lost. So you only get rid of your own property, but not of the husband or wives. And so a basic financial amount can be saved. Good. This is the standard setting for ownership situation in a marriage. Now, if it's a standard, there's also an alternative. You can opt for a different regime. For example, you can opt for the so-called common property regime, gemeinsamer Güterstand. In that case, all what the spouses own is automatically regarded as owned by them together. So then everything they own. So if husband has a car, the car belongs to both. I believe the toothbrush will be excluded, but probably for hygiene reasons. But in principle, everything which they own together. By the way, you can even agree to modify that status in a bit so that in the marriage contract where that ownership status will be established, you can introduce clauses where a part or certain kind of property is excluded from that regime and is regarded as individual property of one of the partners alone. Yeah, but as far as you did not do that, it's clear that if you, as a poor person, marry an enormously rich person, and then you agree on that ownership regime, then from that moment on, you own 50% of the property of that person. So if you own nothing apart from a nice character, and then marry a billionaire who owns 100 million. Here you see I was a bit distracted. A billionaire doesn't own 100 million. A billionaire owns at least 1 billion, okay? So that billionaire shall, let's say, even own 100 billion euro or dollars or so. Now, if you can convince that billionaire to agree on common property status, you would afterwards automatically, 1 second after signing and marrying, you would automatically own half of that 100 billion. Now, that was something which your partner, your spouse, then by marriage, deliberately and voluntarily passed over to you. It's difficult to say if it's now a donation, generous, or if it's just a consequence of the marriage. But the economic effect is clear. Somebody who had nothing is now the owner of half of 100 billion. And now the trick is, if later you separate the marriage and get divorced, and if you then get 50 billion from your partner, then trick. On that occasion, it's no longer a donation because it's no longer enriching you. You already owned 50 billion out of the common 100 billion, so it would neither be generous nor an enrichment. You could not tax it anymore at that moment. So that was the motive to include that on the list. If somebody agrees to change or to establish a marriage under the common property status, the enrichment counts as a donation. Also, if you renounce on an inheritance, this is not really a generous thing, because what you do in as consideration for getting money is that you renounce on a claim to money. So it's not strictly generous or strictly without consideration. But nevertheless, it is a way to bring property in your hands, which is neither an acquisition on grounds of death. You get it during lifetime when you sign the contract by which you renounce on your inheritance claims. And nevertheless, you get money, which otherwise you would have got during the inheritance. So it should be on the list. If you can't really imagine which situation is behind this, you can renounce on the right to inherit by contract, usually then made in front of a notary or so. And it might even be that the other person involved pays you for that. If you renounce on your inheritance, then you get 1 million, 10 million, or what else. So that is a contract between living persons. It's not strictly a donation because you do something in return. And now it would work as follows. Imagine you have a father who is owner of an enterprise. He has a son and a daughter. Now the son is completely incapable of leading the enterprise, at least that's father's opinion. So he wants to exclude that son from the inheritance. He thinks only my daughter can take over successfully the whole business. And so father wants to leave everything to daughter only. Son is... Now the question is, how can you get rid of son? You know, there is a compulsory minimum share, also that might be a risk. So father takes son to notary and says, son, let's now agree on a contract by which you renounce on all your claims to my inheritance. And in return for that, you get now 10 million cash on hand. If that's not too low but attractive, then son probably agrees and says, okay, father, I always wanted to get rid of your financial support. Now with 10 million, I can lead a decent life till the end of my life. So I say yes. In that case, you got these 10 million as a kind of replacement of your future inheritance. And it would not be an inheritance, not a legacy. It would not be a donation between living persons because you do something which has a financial value in return for it. But 10 million would be passed from father to son as a replacement of an inheritance. And so this way must also be taxed. Otherwise, all people would renounce on their inheritance and get, let's say, 90% of its value for free in advance from father or mother. So these 10 million will here be declared taxable under 1.1 number 2, donations between living parties, and it will be clarified or will be regulated in 7.1 number 5 that this has to be seen as one of the potential donations between living parties. There's also something in German law which is called pre-inheritance and post-inheritance or succeeding inheritance. The background is sometimes you have in mind that somebody should take over and inherit your property, but that in the end the property should end up with somebody else. For example, if you are married and have been married, let's say, for 50 years, you would regard it as rather hard if your husband or wife surviving you would have to sell the house in order to hand over a share of the house's value to the heirs, to your children. So it might be an idea to say, my sole heir is my husband or wife surviving me, and my children are excluded from the inheritance. Now, this, on the other hand, sounds a bit unfair towards your children. And now it might be that you say, to secure their position, I make a last will, which says, my husband or wife inherits everything first. But on the moment when my husband or wife then dies, it is already agreed upon, or I demand that my inheritance then goes on to the children, so that your surviving husband or wife has no right to dispose about that inheritance differently. So if your surviving spouse 10 years later gets a fit of strangeness and says, I want to leave all my property to the Church of the Tax-Paying Angels or so, then that would not be possible with regard to everything which you left behind, because the last will of yours already says, no, my property only temporarily goes to surviving spouse, and afterwards it hops over to my children. That is pre-inheritance and post-inheritance, succeeding inheritance. Now it might be that the pre-heir during lifetime already says, well, children here, there is a bit of money, I'm obliged to pass that on to you later on the moment of death, you can get a bit before. That might be possible, and you might then argue this is not a generous donation because I just fulfill the obligation to hand over that property to my children prematurely, a bit before the day when it's due, but it's not really generous. Well, it costs me nothing because I would have to give away that money to them or that property in the last moment of my life. To end all these potential discussions, this is here also on the list. What a pre-heir passes on to a post-heir with regard to the right that the post-heir has finally to get it, even before this is due, that is also taxable, because otherwise it would not be taxable. Not an acquisition on grounds of death, if you do it during lifetime, and so on. The transfer of, I told you that, transfer of property when you establish a foundation while you still are alive is listed here. Also, that is a kind of generous donation here to an institution. You had already the foundations on the list when you make your last will and demand that if foundation is newly established, if you establish a foundation during lifetime and hand over money to it, this is also classified as a donation which is taxable. You find it then in 7. So nothing of which greatly surprises us. A foundation or a private association also can be dissolved, and then usually the statutes of that institution say to whom the money then has to go. And so if there is a foundation which is dissolved after some 50 years or so, and you are then entitled to take over the property of that foundation, that would also be regarded as a taxable transaction. Because otherwise there would be nice tricks possible. I erect a foundation, and 50 or 100 years later that foundation hands over all the property to my grandchildren. Then I would have saved, let's say, 2 generations of inheritance tax. Here the law says no. Good. One also could play some tricks by saying, yeah, we only have to tax donations, so things which are generous events, and we could say we demand a consideration in return for passing over the money or the property, and then it's no longer generous, that's no longer a donation. The trick would be to say, I demand a consideration which is not really a burden, at least not a financial one. My trick, my first idea would be, you get an amount of 1 million, but in return for that, you take the obligation to make 3 prayers a day for me, my health, and my soul. And if you violate that, you lose your right to the 1 million. Now you could argue this is no longer a donation because I pay for a counter-performance consideration. Now the law says, well, this is rather a sham. Huh? So this does not count as a real consideration. Or you might say, you get 1 million, but you oblige yourself always to speak and write nice about me. Also that. Well, okay, if somebody gives me 1 million, my personal inclination to speak bad of that person is a bit low. Huh? So that does not really matter, but it would be a formal trick to avoid the classification as a donation. So the law saw the need to clarify that and to say that loophole is closed. 7.3 of the Inheritance Tax Act says a consideration which has no financial value will not be considered when the question has to be decided if there is an enrichment of the donee or not. Huh? So that means you get 1 million, and is there any financial burden combined with that on your side? Do you have to do work in the value of 1 million or anything like that? No, you just have to make 3 prayers a day. Okay, it doesn't count. So you are enriched by 1 million. You can neither deny that it's a donation nor deduct anything as financial value of that obligation from your enrichment. The same applies to cases where you mask a donation by a bilateral contract or by posing a condition, which does not really matter. So also will not hinder that taxation. Furthermore, a few clauses have been added to the list of the donations between living persons where economic life presented some problems. For example, when you are a partner in a partnership and you have 1/3 of the partnership, now the partnership has financial problems. So you make a contribution of 3 million into the partnership and the other 2 partners don't. But you don't modify the partnership contract. So the partnership contract says every partner has a right of 1/3 in the property. And now if you pay in 3 million, that would mean 2 million directly become the property of the 2 other partners. And that would be a kind of a donation to the 2 other partners. Now you could say, I just did it in order to save my partnership, and it was not my primary aim to donate to the others. And all that stuff led the legislator to clarify the situation by adding additional clauses to paragraph 7, which dealt with constellations of that kind. For example, 7.5, if a donation consists of a participation in a partnership, there is a first problem. It might be that I give you a partnership position. I make you my partner. Let's say your share in the partnership has a book value of 1 million. And then I write down a clause. If you do something which really makes me angry, I can revoke that donation. And then you have to leave the partnership, let's say, without any compensation or compensated only as far as the book value goes or so. Then the law says you can't argue that this is not an enrichment because there is a potential obligation to hand it back. It would be regarded as you are enriched under a so-called dissolving condition. As long as the condition is not fulfilled, the enrichment exists. It would only fall away when you have to hand back the partnership share also. 7.6. If you give somebody the position of a partner, let's say that person has to pay in 1 million, your capital is 100 million, and you say the new partner gets 50% of the profit as I have, then this is entirely inadequate. So what you then do by signing that partnership contract is you make a kind of a donation to the other partner. You, nearly for free, give away a right to 50% of all future profits of your partnership, and that is, you make a donation to the other partner. The constellation that you pay in contributions, which are very high, and where the other partners also benefit from without having to do comparable contributions, that is regulated in 7.7 and 7.8 also says something about when you make contributions to a corporation or a foundation and others profit from that directly under the statutes of that corporation, then this is also a donation to the other shareholders. For example, what I explained to you just a minute ago regarding partnerships. Let's say your company has problems and now you pay in 100 million euro, but you don't insist in an increase of the shares for yourself, so that you only own 25% of all the capital and the property of the GmbH, then it would mean 75 out of that 100 million which you paid in additionally to save the company now indirectly increase the value of the shares of the others. You have lost that money because in case of a liquidation, these 75 million would go to the other three shareholders holding 75%. In that case, paying in money under these conditions would be regarded as a donation to the other shareholders. That's clarified in 7.8. So you see, the list of taxable transactions gets longer and longer in the course of time when people come to ideas how taxable events could be circumvented, or at least where it could be doubtful if it can be viewed as a taxable event. Then the legislator clarifies things by enlarging the list. Well, the only thing which I think you have to memorize after this overview about the taxable transactions of today is that donations among living persons always are taxable, that the details are regulated in paragraph 7, and that naturally you should memorize overall that each inheritance tax must also include gifts and donations, otherwise you can forget about the whole tax immediately. The only question was and is always by or where countries can then vary with regard to the system. The only difference which can exist is how many years before the inheritance will be included concerning the gifts and donations. And now you see here under the German legal system, 1.1 number 2, every gift and donation is a taxable event. That means even 1 year after your birth, if you then receive something from father or mother, this is a taxable event in principle. Throughout your whole life, so there is no time limit basically for taxing donations. I told you already about the English solution. There they say the inheritance is taxed, and added back to the inheritance will be the donations which the dying person made during the last 7 years, so before the inheritance case came up. So a different approach. Huh? So what should be kept in mind here is donations under the German system are always a taxable event. Naturally, we will learn later that there are certain things which are tax-free due to their unimportance and due to the need to simplify life. But in principle, every gift and donation triggers an inheritance tax case. Thank you for listening. Would be nice to see you again on the channel sometime, and till then, enjoy your time and don't forget to come back. Thanks for watching. Till later.